Hello, Professor. My name is Ali Askeri, and today I want to talk about the Liberation Day tariffs and the global impact that it has to this President Trump decision. On the April 3rd, 2025, President Trump unveiled a broad set of tariffs globally, which he called the Liberation Day package. So, as a result, the financial market around the world reacted immediately and facing the worst stock drop since March 2020, which was a pandemic. And in this presentation, we will walk through this announcement itself, and also we explain the immediate market reaction to this decision. President Trump tariff plan hit both rivals and allies, and the starting number for this tariff was 10%, and which start from on the imported goods started in April 5th. And the higher rates for some countries is starting from April 9th. For example, the European import goods face 20%, Japanese goods 24%, Chinese 34%, and Vietnamese 46%. And the size of these tariffs was really broad, and actually this shocked the investors, which led to the Nasdaq falling nearly 6%, and the S&P dropping to almost 5%, and Dow Jones slipping close to 4%. And also some companies like Apple and Nvidia combined lost almost 470 billion. So the impact of these tariffs and the size of it caused a global market a stock drop $2.5 trillion, and also in America, and as you can see on the chart from Yahoo Finance, the S&P 500 almost lost $2.4 trillion by the end of the day. But as we can see, the following trend actually it recovered, but the drop that day they faced on that day was so dramatic. At the same time, the VIX jumped to its highest level in the 5 years, showing the investors' anxiety from this situation. And so, what is the VIX? The VIX is the fear index, and it's a number that measures how much the traders expect the US stock market goes up and down in the next 30 days. And the calculation is based on the option prices on the S&P 500. If the investors are buying a lot of these options, the VIX goes up. Tariffs make the export more expensive and reduce the imports. So that's why the investors immediately cut their the projected profit, and they demanded a higher return to compensate that additional risk imposed on them. Also, a higher required return causes a lower share price. That's what exactly why we see in the tech companies stock, specifically a huge decline, as I already explained it in previous slides. The companies like Nvidia and Apple, they almost like around $470 billion, because these companies heavily rely on a global supply chain. And also in the case of the bonds, when the tariffs announced, most of the investors look for a safest option they have, which was the US government bonds. So this pushes the bond prices up, and consequently the yields goes down. For example, if as we see on this slide and on this chart, the 10-year US Treasury yield dropped just above 4%, which reached its lowest rate and level since October. However, on the German and French bond yield, it was a little bit different because it didn't fall that much, as we can see on the slide on the charts, because the government were prepared to issue a lot of new bonds, so the investors knew that it put the upward pressure on the yields later. And at the same time, the US dollar weakened because the investors were worried that tariffs slowed down the growth and forced the Federal Reserve to cut down the interest rate. So the lower US interest rate make the dollar less attractive and profitable. So the investors can move their money into other currencies like Swiss franc and Japanese yen. And since the US has the free capital flow, as we actually learn in the class from the Impossible Trinity, it allows the investors that easily move their funds across the borders out of the USA into the other currencies, which look safer and offer the better returns to the investors, which this one also puts the downward pressure on the US dollar. When the tariffs hit in April, market become very unpredictable and the companies had to react very quickly. So these companies shifted their currency hedging from a short term, which was a 3 months, to a longer ones, which was a 2 to 5 years. And the main reason was the cost of it, because a 1 month option becomes 72% more expensive, while the 2 year ones become only 23% more expensive. And also to manage this situation, companies started using different tools like a window forward, which is a little bit different to the normal forward contract. It doesn't have that certain date that we can see in the normal forward contract, which gives more flexibility to the buyer, and also a zero premium option. And between these two, the investors preferred options over a simple forward contract because of that flexibility that it gives to the buyers. And also, hedging moved from a Canadian and Mexican currency toward a euro as the dollar got weakened. And also, as we can see on the slide, a survey by a trade magazine showed that how the widespread was this shift. Like around 69% of the companies said unpredictability had hurt their profit, and 95%, 91% reported hedging foreign exchange risk, and also 64% planned longer hedging, and 86% were using foreign exchange options. So when the US tariff were announced, the European stocks quickly dropped. For example, the SOX 600 dropped 2.5%, and the leaders of European Union began to prepare their retaliatory tariffs. And since the tariffs actually targets the imported goods and it makes it more expensive, uh, there was a real concern in Europe that people actually buy less, and also the businesses hold back on their investments. Also in Asia, the countries like China, Japan, and Vietnam actually faced the highest tariffs. And the market also fell as well, but it wasn't really sharp like the one we saw in the US because their economy wasn't dependent on the US consumers. And in the commodities, the investors actually feared a worldwide slow growth because the oil price dropped. And this is really important for the exporters like Canada and Norway because the low oil price, it means the government has a less revenue to spend. And also at the same time, it weakens their currency. This was my presentation about the Liberation Day tariffs announced by US governments. Thank you, Professor, for the whole course that we had, and I hope I fulfilled the expectation that you had in your mind for this presentation. Thank you.